Well, thanks very much indeed for the opportunity to speak with you this morning. Really strong set of numbers that we're reporting today, and delighted with the performance of the bank in 2022, which I've previously described as a hinge year for AIB. On the impairment line, it was a year of two halves. First half of the year, we took a very, very significant write-back, which was driven by actual credit experience. It was driven by actual credit loan repayments. Second half of the year, we took a significant provision, leading to a net 7 million for the year as a whole. But the significant provision was not driven by actual credit experience. It was driven by a post-model adjustment to reflect the fact that we are heading into more uncertain economic times, that we are dealing with the prospect of higher interest rates, and that growth is likely to be significantly more moderate in 23 than it was in 22.
Colin, just looking at the interest rate story there and revisiting an article from last year pointing out that the Irish banks stand to benefit from the interest rate moves. 80% of income generated effectively from those interest rate moves, just 20% from fees, very different to the rest of Europe. So as interest rates go up, surely that means there's going to be more momentum in your business.
Well, the Irish banks are amongst the most interest rate sensitive across the Eurozone, and that was something of a negative for the industry over the course of the past 10 years, when the banking industry was dealing with the reality of negative interest rates across the Eurozone. There's a balance to be struck in terms of how we respond to higher interest rates. We're very conscious of the need to balance what we do on the mortgage side and on the deposit side, and we've been doing that in a very, very measured and considered way since the rate increases started in July of last year. We have a medium-term ROTE target of 13%. We're seeing strong momentum in the business as we turn into 2023, and we are expecting that to be comfortably exceeded in the year ahead.
Colin, very good morning to you, sir. Does it matter how much of a stake the government still has in your bank? Of course, there's been a sell down under the current Minister of Finance and the last one as well from over 70%. It's going to get to circa 50 or perhaps even go below. Does it make any difference to you?
Well, I think it makes a difference to our shareholders. The larger the free float, the better for investors. Investors want to be investing in a company with increased liquidity. And we have seen the government's shareholding falling from above 71% to where it is today, above 55% since the start of last year. And obviously further share disposals are a matter for government. But the lower their presence on the share register, the better for other investors because of the free float impact.
I'm going to call it quite bluntly here, Colin. Do you think you're underpaid compared to peers who don't have a government stake? I notice the salaries of the CEOs in the United Kingdom, and there are multiple of yours at the moment. I know you're a well-paid man, Colin, but actually attracting talent with a pay cap of €500,000, is that a problem?
Well, I knew what the deal was when I took the job on the very first day, and it is an extraordinary privilege to lead this organisation with 10,000 employees and 3.2 million customers. I knew what the deal was. I'm concerned with influencing the things I can influence, leading the organisation to the best of my ability, delivering quality products to our customers day in, day out, doing it in an environmentally and responsible way, and returning decent dividends to our shareholders. I don't spend too much time worrying about things that lie way outside the bounds of my influence.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.